Hi, I'm Dr. Kevin Milo, and you're listening to the Physician Empowerment Podcast. At Physician Empowerment, we're focused on transforming the lives of Canadian physicians through education and finance, practice transformation, wellness, and leadership. After you've listened to today's episode, I encourage you to visit us at phys-empowerment.ca, that's PHYS, empowerment.ca, to learn more about the many resources we have to help you make that change in your own life, practice, and personal finances. Now on to today's episode.
So welcome everyone to this very unique year-end live webinar episode for Physician Empowerment. And I love this time of the year, not the snow dump that we have tonight in Edmonton, but with snow, it's Christmas, holidays, Hanukkah, whatever you subscribe to. And it's really the close of the year, and then you're planning the next year, right? So you kind of plan ahead, and there are people who said that people don't always do planning. In fact, they do more planning on their 1 week holiday than their whole financial life, right? So it's always good to have a year-end reflection and a glimpse of the next year. So this is the time when you want to have a crystal ball and see what's going on next year, but of course you don't, right? So we do the next best thing is we interview people who have the crystal ball. No, I'm just kidding, right? So today I'm very, very excited to have Diana Choi to be our guest tonight. And Diana comes with strong credentials. She's a portfolio manager, and she's not just a regular portfolio manager. They're all special, but she is a team lead of a group of them. And her job is to look at the public markets. And so there are a lot of things happening. So we'll dissect things a little bit. Of course, everybody talked about the election in south of the border, the Trump trade, Trump 2.0, whatever you want to call it. And there's a lot of nuances to that. But before we dig into the details, and we don't want to just talk about politics today, right? So with the time together tonight, we want to talk about, at the close of the year, there are many things changing. We'll name some like geopolitical changes. There are wars happening, there's trade wars, there's real wars, there's cold wars, and then there are some hot wars. Hopefully there's no nuke wars. And then there's interest rate environment, there's the recession question mark, right? And then bull versus bear market question mark. There's this big tariff coming up, question mark, double question mark. And there's a lot of things going on. So before we look forward to that, Diana, and again, thank you for joining us. I would just like to know as a professional, right? So people, I share with you, and there are a lot of our listeners are medical professionals, right? In the physician community in Canada, there are big two camps, right? Camp one are people who just do everything DIY because that's how we're bred. We're bred to trust no one, right? And do everything ourselves. And so they just thought they can digest everything themselves. And they just buy ETFs and they would just retire in glory, right? What a myth, right? And then the other type is they just gave their money, their hard-earned money to some professionals that could be their advisors or educators, but actually the only thing guaranteed is the commission, right? And the docs don't ever know, right? And one example is I have a colleague who just retired, and the advisors, wealth advisors say, Doc, for the last 20 years, I have made you 20% per year. And wow, I didn't know my friend hired some real goddess or demigods of stock market like Warren Buffett, right? To enjoy 20%. He believed it, right? So these two big camps. So today, it's no better occasion to talk to a professional who looks at the public markets every day, right? And you take a team, right? You guys have what, $2 million, $2 billion with the BAUM. So how do you look at every day? How do you look at these at the market things? How do you digest all this as a professional?
Oh, that's a great start. And, thanks. First of all, thank you for having me. Looking forward to our discussion. I think you really touched on something that goes at the heart of some of our investment philosophy, which is how do you invest or make decisions for a future that, in our opinion, is unknowable for the most part. There's specific things that you can say perhaps you might know, but for the most part, in our experience and in our overall philosophy, our opinion is that the future is unknowable. There's very, very few individuals, potentially none really, in the investment space that has consistently forecasted the future to any really any extent. There might be individuals who accurately have called for one event in the course of a 20 or 30-year event, but that only gets you so far. So I'll start with our investment philosophy, and the one that has really worked well for us over the 25 years that since we've been in business, is the idea that you invest in quality businesses. And it sounds like a very simple mantra, but ultimately what we would say a quality business is what we define as a company that can do well in most situations. Certainly in a recession, nobody expects a high quality company to continue to grow. But we expect that a high quality company can survive better than most and can thrive better in good environments. And if you can build a portfolio of that sort of portfolio, then what we generally expect to happen is that it'll deliver better risk adjusted returns than the market. And what we mean by risk adjusted returns is for the amount of risk that you're taking, you get a certain unit of risk or a certain unit of return. And what we believe that we can generally produce on a consistent basis is a better risk adjusted return. And we've certainly demonstrated that over the cycle. And that's just largely what our investment philosophy is meant to drive.
That's very interesting. So it's not just luck. There's no Ouija boards. There's not flipping a coin, right? So that is interesting because buying good companies versus just picking stocks, I think there's huge fundamental difference. Right? Or people just say, okay, buy crypto and there's some magic spells, right? And it's just going to go through the roof, right? And so there's a book called Good to Great. Okay. Now people in the business world, everybody knew about this book. In my world, it's a relatively unknown book. I read this book 15 years ago, I guess. It's a tough grind, but I actually teach it in the master class, right? So basically, Phil Collins, him and his grad students pick, 1,000 companies. These are publicly traded. These are good companies, right? And the great companies, and there's only like 11 pairs, right? And those go from good to great. And the definition of great company versus good is they win. It doesn't matter what market cycle they went through, and it's over accumulated, 17 years. And you have to be 17-fold above the market returns. Like these companies truly, they reach greatness for decades and decades, some are centuries. So those are the winners, right? Like you talk about these winners that would win no matter what, because they don't just based on luck, right? They base on real good fundamentals, right? So that's your philosophy. So then it's a lot of work.
It is. We have multiple full-time professionals that do it, and certainly it gets better with experience. But it's certainly something that we dedicate our full-time jobs to look for companies, to talk to management teams, to assess whether or not our original investment thesis is correct in the first place, and make decisions in terms of how we buy stocks or sell stocks as we assess the investment thesis.
Right. So with things that are changing rapidly, okay, let's dive into the big elephant in the room. More likely, this is an elephant that hasn't even taken office yet. And the world is coming down, including our prime minister going there and paying homage. So with Trump 2.0, okay, we're still how many a month and 20 days away. And so what do you see? Like I'm actually taking a master class myself, right, as a student, and we're learning about public markets. We're learning all sorts of things, alpha value, right, and the R value, all these crazy things, fundamental analysis, technical analysis, and big funds companies are picking the templates and the Harris templates, and now the Harris templates are done. Right. So how do you think that's going to affect the public markets altogether? Then we'll talk about Canadians later.
Yeah. So maybe I'll start with, if you look at stock market performance over a period of greater than 6 months, you'll find that presidential cycles actually do not affect equity markets, certainly over the long term. There's a lot of volatility in the short term, but we're not short-term investors. And this goes back to our original philosophy of it's hard to tell the future. So if you don't know before it happens whether or not Trump would win or Harris would win, and that there's a lot of volatility, well, you could try and position, but if you don't know the future, you don't really, the chances of you being right are 50% at best, I guess. So that's not what we do. But we're long-term investors. And when we look at the markets, presidential cycles do not affect it over the long term. If you look at what Trump wants to do, Trump 1.0, or Trump, what he has done in the past, it's very hard to take for face value what he says, because what he says and what he ultimately gets done can be extremely different. So how do we make decisions on that? It goes to the quality aspect. And ultimately what we would say is our portfolio of companies, by and large, I would tell you we're comfortable with these investments with Donald Trump in the office, with Kamala Harris in the office, with Biden in the office. These companies have strong enough franchises, and probably most importantly, are not reliant on any one president to be in the office for that investment thesis to work. And I'll give you an example because I think it's much easier, I think, to explain in an example. One of our largest positions in the portfolio was CCL Industries. This company is a label maker. So if you look at a drug bottle, if you look at the label on a Ozempic, if you look at RFID tags on an article of clothing that you want to buy, that's what they make. And then when we look at that sort of investment, it generates a significant amount of excess cash flow. So they need a lot less cash than they actually generate, so they can buy more things. It's a dividend grower. The growth by itself is based on their ability to take market share and by general global economic growth. When we look at a company like that, we don't look at it and say, yeah, that's a Trump stock or that's a Harris stock. We look at that and say, this is a good company and it's a company that we want to invest in over the long term. Doesn't matter who's in charge.
Mm-hmm. Right. So again, it's just not what is hot, where the wind is blowing, what is sexy, right? What is the in thing, right? What
That's
is right. Right. And definitely you're not into what do you call it, the day trading kind of a mentality, right?
Yeah, we are long-term investors. We're of the opinion, if you find a good quality company, there is no expectation of us to exit the company at any one point in time. We have investments within our portfolio that we've held for a very, very long time, well over 10 years. And these companies are the ones that we love to own, frankly, because they're the ones that continuously compound capital. When you find them, ultimately, your biggest decision in any given day is, well, what's the valuation? Do we need to trim a little bit? Do we need to buy a little bit more? But ultimately, it's a high quality company, and we're always very happy to invest in it over the long term.
Right. Yeah. Amazing. So now I know that you are head of a Canadian equities portfolio. So with this 25% tariff scare coming, how do you see that impact A, us Canadian industries, and B, these stocks, these great company stocks?
Yeah, that's a great question. So I'll start with what Trump says and what ultimately gets done are very, very different. Certainly our base case is not an assumption that on January 20th, there will be an automatic 25% tax slapped on every single item that leaves Canada and goes into the US. We think this is a negotiating tactic. So I'll start with that. How are we thinking about tariffs? So ultimately, not surprisingly, it really depends on where it's going to be implemented. I'll tell you some of the things that we think about in terms of the relative risk. Energy is actually a very, very large export product of Canada into the US, oil and gas. 25% tariff on oil and gas would be extraordinarily damaging both to Canada and frankly also to the United States. Energy is, certainly oil and gas are integral parts of the economy. We're certainly in a transition mode and we want to get to a greener economy. But certainly right now, oil and gas is still a very, very large part of the overall economy. And the United States still relies on a lot of Canadian energy. So we think that would be very damaging. So overall, don't think that that's necessarily our, most likely good to be taxed. The other one that is regularly talked about is auto parts. The stats that you might hear on auto parts is that a car that you would drive off the lot crosses the Canada-US border about 7 to 8 times before it becomes a fully completed auto product. So if you think about that from the perspective of if you put 25% tariffs on, half completed product A, moves across the border, another 25% tariff, another 25% tariff, another 25% tariff. Auto cars would be largely unaffordable under that sort of scenario, which is, again, one of the reasons why we don't think certainly a full 25% tariff, again, on every single good is realistic in the auto side. And then when you start going down the list of other areas, that's when we start to see, it might be more of a negotiating tactic. But something that we should keep in mind is that there's the tariff, which is, maybe sort of within Trump's control. Something that's not really in Trump's control is the currency. So in a high tariff environment, there's a very good chance that the Canadian dollar will depreciate. And depending on how high the tariff is, and how badly the Canadian dollar could depreciate, that might actually be a bit of a natural hedge to, the Canadian economy. Not very good news for those wanting to travel, south of the border, to hear that, our currency could be even weaker than it is. But certainly for Canada, which is a net exporting nation, that is certainly one thing that, something to keep in mind as far as an investor is concerned, as far as overall profits. For many companies that are publicly traded, you derive a lot of your revenues from outside of Canada. So a weak Canadian dollar actually in a translation mode, actually it works out better for you, all else being equal.
Yeah, anybody who wants to win the export world, they have to depreciate their currency, right? And US is actually essentially going to do the same game. So talking about Canadian industries and Canadian equities, so there's something very unique about Canada, right? So I listened to a lot of podcasts and webcasts of all sorts. And I've heard that we are actually the breadbasket of the world. Right, and with energy, and then now the world is going electrified. They need nickel, they need cadmium, they need uranium. As the world goes nuclear, even not in the power, but in the power generating business, not in the warheads. So we have a lot of stuff to offer from a Canadian shield, right? So do you, as a Canadian equities specialist, so do you see that we have a bright future in the coming year and the years?
Well, I'll take this from two perspectives. There are industries that could potentially grow significantly, and then there are good investments. And they are sometimes related, but they're not always related. As you might remember, Canada was one of the first, or one of much earlier than the United States, in legalizing marijuana. There was a lot of marijuana stocks. Many of them appreciated in value significantly under that excitement. None of them ultimately turned out to be particularly good investments. So there's a real difference between a rapid growth of an industry and there being good investments. From our perspective, when we think about Canada, I won't give you my crystal ball because we don't necessarily create one ourselves. But what we do see is that the Canadian market is at a significant discount to the US market. Canada's average price to earnings ratio, which is the one that is regularly quoted, we just made. So it's been a very strong year in Canadian equity markets. Even after this year, we're just back at just below average in terms of a long-term median type of valuation. So if you contrast that with the S&P 500, we are making all-time highs in terms of price earnings. So the gap between the Canadian market valuation and the US market valuation has been extraordinarily high, and if anything, has actually grown over the last couple of years. So I won't sit here and say, well, there's going to be no recession next year, or there will be some recession next year. But what I'll say is, if you think about downside or risks to losing money, you lose money because you paid too much for something and it went down, or a company that you own, earnings fell and you didn't expect it. The earnings risk will always be there, but certainly when we look at valuation risk, we think Canada has a lot less valuation risk than the United States.
So now maybe slow down, because I think valuation risk itself, that term, that concept is very to us. Can you water it down a little bit for us?
Yeah, no, for sure. So if you look at, let's say, a typical investment that everybody will probably know, TD Bank, for example. In the public market, a typical Canadian bank trades for somewhere between 10 to 12 times price to earnings. So whatever TD Bank earns in terms of earnings per share, if you multiply that by 10, that's usually the low end of what somebody is willing to pay you for that stock. On the higher end, when the economy is really good and everybody's very optimistic, we see lots and lots of opportunities. You can often get away with selling a TD Bank or any bank for around 12 times price to earnings. So, whatever you think the earnings is of a TD Bank, multiplied by 12, that's probably what the share price is, and that's what you can sell it for. So when you think about downside, there's a lot of different ways to lose money in a stock, but really it boils down to two things. It's earnings or it's the multiple. So how do you lose money? You think TD makes $6 a share, $6 per share of earnings per share. And it turns out they made 4. Well, 4 times 10 is a lot less than 6 times 10. On the other hand, if you were very, very optimistic and you said, well, you know what, I think TD Bank will make $6 a share earnings per share, but I'm going to pay 13 times for it. Well, it turns out you pay too much for it, and the person buying it from you is only willing to pay you 11 times, then you're still going to lose money, even if you're right about the earnings. So what I think about, if you take that at the higher level in terms of the index itself, you could be wrong because the Canadian TSX index made less money than you think, and that could happen because of a recession. It's the index earnings is just the amalgamation of all the earnings of all the publicly traded companies within the TSX. You could be wrong because they made less money, or you might just pay too much for that earnings stream if you buy the index itself. So when I say there's less valuation risk, the average investor is willing to pay a much, much higher multiple for the earnings stream of the S&P 500 than they are for the earnings stream of the TSX index. So that's when we say, well, if you pay too much, well, one of the things that happens if you pay too much is you're paying a multiple that's too high. We look at the S&P 500, the multiple's high, significantly higher than the TSX.
Right. So let me try to digest that and regurgitate that and see where we lead to. So from what you say and my understanding, if you buy stocks, even though they're hot, even though the fundamentals are good, they're making money. But if you buy them at such a high price, then when a jerk happens, right, the market jerks, then you could potentially lose a lot of money, even though these are great companies.
Absolutely.
For example, the Magnificent Seven, right, in the States, right, S&P, all these big technology stocks, everybody's still buying, like, the NVIDIA of the world, all those, right, and Teslas of the world. And I still have colleagues just kept throwing money at them, right? And so what you're saying is, even though those are great companies, they're doing good, the fundamentals are good, but because the price is because the valuation is so high, right, they're too expensive, right?
Yes.
So even though every quarter they churn out profits, at the end of the day, you can still lose a lot of your hard-earned money.
Exactly. Like if you think about it just in terms of, think of shares as an ownership. If you buy something like a bank at 10 times price to earnings, well, assuming earnings doesn't grow, you'll get your money back in 10 years. For that same business, if you pay 35 times for it, if earnings don't go up, it's going to take you 35 years to get back your money. So that 35 times, what you're implicitly saying is, well, I think there's going to be growth, or there better be growth, because who wants to get their money back in 35 years? You're hoping for something a lot less. So that's the dynamic there. And when we look at the TSX, we look at the multiple of the TSX index, and we see it at a significant discount to the S&P 500, which, if you look at it from a macro perspective, the valuation risk is lower. So in case somebody says, well, I don't want to pay, X multiples for your index, I want to pay something less. Well, the multiple you're paying for the TSX is already pretty low.
Cool. So investing TSX versus S&P, is there also a tax advantage?
You know what? That I have to admit, I don't know. It ultimately really depends on your personal situation, but there might be some tax difference.
I mean, like when you invest in the U.S. market, don't they do those tax withholding thing?
I believe so, Wing. I believe so. I have to admit, personal. It ultimately depends on everybody's personal financial situation, but yes, there is withholding tax within the U.S.
Yeah, because I use interactive brokers where they say whatever you do to buy it in U.S. stuff, right? It's on currency, they withhold the tax, right? Whereas buying TD Bank, right? Your Canadian bank, TD Bank, you don't have to deal with the American tax, right? So that I think that's another kind of thing people should consider. So I'm not saying that we should just deal with that now. Maybe let's jump into different space and talk about mentalities, right? So for a lot of people who just want to work 60, 80 hours a week, busy medical professionals, and just geek out on, a few hot tips and do a DIY thing, right? So that those that would just based on what the hottest tip they heard at the locker room, at the OR room, and that's how they're going to navigate in their work. Or versus the others, my other side of my colleagues that are just going to buy index funds. So why would you say, as a professional, like how would you predict their future in their wealth accumulation?
Well, you know what? I think that there's always a certain amount of cachet and a certain amount of excitement at being told about a exciting investment opportunity, buying something that is extremely volatile, and you wake up and the price is $10, and you go to sleep and the price is $20. There's a certain amount of excitement there. What we'll say is our philosophy is steady compounders over time certainly provides better outcomes. So that is what our ultimate philosophy is. And it's also something to keep in mind that, with a lot of upside often comes a lot of downside. And I find it's underappreciated that losing a lot of your money is actually quite damaging for your long-term financial goals. It's mathematically correct, but if you lose half your investment needs to double just to get back to where it is. So there's a lot of, from our perspective, downside protection is really important to us.
Let me just interject and reinforce that, right? Yeah. So if you lose 10% this year and gain back 10% next year, you didn't recover.
You're
right?
not better
double,
off.
right? If
Yeah.
you 10%, you do 20%.
Yeah. So it's like that number works all the time. Like, if you lose 10% and then you gain back 10%, you're close to where you started. You're not quite there. But if you lose 25% one year and you gain back 25%, you're pretty far off. If you lose half of your money and you gain back 50%, you're not even close. Mm-hmm. So it's something to keep in mind, and it's something that we really focus on in terms of downside management. So if you look at our track record for better risk-adjusted returns, we outperform the index. But how do we outperform the index? We don't necessarily outperform the index because the TSX is up 25% and we're up 50%. We outperform because if the TSX is up, we capture 80 to 90% of the upside, but we aim to capture significantly less of the downside. Because if you lose less of your money, there's a much better chance that you can compound into it during better times. So that's our philosophy, and that's what we think derives differentiated returns relative to the benchmark.
So I heard different people, like these are big thinkers, right? And a lot of the network of very wealthy people, right? And they say that I don't need you to make me rich. Just don't gamble my money away. I think that's axiom number one, really important, right? We all got there, right? We are high income, right? If we things right, we will accumulate wealth, right? But just don't gamble it away, right? And that's one. And two, it is the slow and steady pace, like you said, right? Like it's like what that little story about the turtle and the hare, right?
Absolutely.
You don't just jump, right? You just slowly, steady. That's it. I remember I used to drive down to Calgary a lot, twice a week. There was time for Edmonton, 3 hours one way. And I remember if I didn't have, I've seen cars pass me and then I pass them again, pass me and I pass them again. But why? Because I put on this thing called the cruise control. Right? So I set 100, 110, 120, whatever it is, and just steady wins it, right? Slow and steady does it. So I think that's a very important philosophy. What about people who just believe in just buy the index fund, fire everybody else? What would you say to those people?
Well, I think that buying the index fund, you get exactly the returns of the index fund. So there's no chance for you to outperform. There's also no chance for you to underperform. But it's also a question that you have to, the client or the individual really needs to ask themselves, which is that the index is actually quite volatile. There are absolute many times where the index both on the Canada side, both on the S&P side, where there's significant drawdowns. What we think we provide a differentiated return is that we soften the blow on the downside for clients. It is rewarding, and it's certainly something that we always aim to do. That in down markets, we try to protect and we try to do significantly better than the markets. So in the years where the markets are down, and it absolutely happens, and you're not feeling very good about yourself and your portfolio's down, we're hopefully telling our clients that you've lost some money, but you've lost a lot less than the markets. So which is good, because you've lost less money than the markets, but more importantly, there's more money for you to invest now for the eventual bull market that comes after a bear market. So it benefits really both ways.
Mm-hmm. Right on. So our colleagues give them and trust their hard-earned money to professionals like you. But then I came to realize that there are two kinds of investment advisors, right? There's some that they call themselves PMs, portfolio managers, but all they do is to buy ETFs, to be honest, right? Templates, right? And then there are those like you who actually pick stocks, and I think you told me in previous encounter that it's like you meet with the people from the company, like CFOs and CAO, whoever, COO, and actually as if you're actually buying it, right? So what's the difference between the philosophy and the outcome of these two types? I'm not trying to name names, of course, right? So, but that sounds really different in their approach to wealth accumulation.
Yeah, and your observation is spot on, because I find that the two titles can be quite misleading and cause confusion. Maybe I'll start with, well, let's call it an equity portfolio manager. That's probably the best differentiator that I can provide. But what my day-to-day job is to meet with management teams of publicly traded companies, to pore over financial statements, to be the Excel junkie, and to make the decisions in terms of buying and selling investments. But probably more importantly, what is it that I don't do on a regular basis? I actually don't do stuff like this on a regular basis. I don't necessarily talk to end clients. Certainly my colleagues, Vanessa and Jesse, they'll pull me in. There's a real important question if their client really wants to know something about company XYZ that we already own, or they want to know our views on another company that maybe we don't own, but maybe they own in their personal portfolio. They might pull me in for that. But that's certainly not my main job. I follow my colleagues, and they tell me to talk to folks like yourself, and I talk to folks like yourself and try to answer questions as best I can. But on a day-to-day basis, if you want to know whether or not you should be a 60-40 balanced fund or a 70-30 balanced fund, that's not actually necessarily my purview. I ask my colleagues for their opinions on that. My direct job is actually just on the investing side of things.
Mm-hmm. So people who just whatever you call themselves, call themselves just pick ETFs. What do you think different than what you do? Like, what do you think the outcomes, right? At the end of the day, we're all customers, right?
Yeah.
So what's your take about just buying ETF templates versus picking stocks like yourself?
Well, so I'm an active manager. And what I mean by active manager is that I actively choose the investments that go into the portfolio. I'm a believer that active management produces better risk-adjusted returns over time. So not better absolute performance each and every year, but better risk-adjusted performance every time. And assuming that our philosophy matches up with the client's philosophy, which I think it often does, in that, to your point, many clients that we talk to regularly say, I'm not looking for the big returns. I'm not looking for plus 30, plus 40. I'm looking for, you're doing okay in the up markets, but you're really protecting my downside. Assuming that that is really the profile that the client has, that's something that we can provide that an ETF doesn't provide. So that I'll go with that. If the client says, I really don't care, all I want is just a market-based return, then the ETF is for you. But in my personal experience, many clients really prefer that, like, focus on the downside protection. Please don't lose me too much money in a bad market. Please make me a good amount of money in a good market. Give me good risk-adjusted returns, and I'm happy to do that.
Oh, wonderful. One last question, and this is the crystal ball. So 2025, what do you think is ahead of us for all of us investors?
You know what, I wish I could answer that, because that would make my job so much easier, Wing, if I knew what's going to happen. I'll tell you a couple of things that I've noticed, and maybe we can end with that. As I said, I've noticed that the Canadian markets are at a significant discount to the U.S. markets. So I think that in a bear market scenario, certainly on a valuation side of things, we think that the Canadian markets are better insulated on that front. What I'll say is 2024 has been, in a Canadian sense, has been extremely challenging for the Canadian consumer. And the Canadian consumer is a good part of the Canadian economy. You've had, the Canadian consumer has more mortgage than those south of the border, has more household debt than those south of the border. We've had an unprecedented amount of population growth without the commensurate business growth, which has led to very high inflation. So not only are you seeing your disposable income shrink because interest is eating up more of it, you're also seeing that the shrinkage of your income isn't going as far. So I think 2024 has actually been very challenging for the Canadian consumer. We're looking forward to 2025. Interest rates are falling, mortgage rates are falling. The Canadian government has been very clear that they want to slow down population growth. We think that 2025 might actually be a better year for Canadian consumers. So those are the things that we're observing. We're observing that, mortgage rates are lower, inflation is slowing. The Canadian market is at a very good discount relative to the US market. And those are some of the things that give us some optimism, regardless of what happens in the global economy.
Right on. I like that. I like an upper as an ending. So happy 2024. Let's fold it over, start a new page. Well, thank you, Diana. This has been really fun.
Absolutely.
And we look forward to hearing back from Diana. I'm sure down the road we'll have her back at our episodes. Thank you.
Thank you. Thanks for having me.
Thank you so much for listening to the Physician Empowerment Podcast. If you're ready to take those next steps in transforming your practice, finances, or personal well-being, then come and join us at phys-empowerment.ca, PHYS empowerment.ca, to learn more about how we can help. If today's episode resonated with you, I'd really appreciate it if you would share our podcast with a colleague or friend, and head over to Apple Podcasts to give us a 5-star rating and review. If you've got feedback, questions, or suggestions for future episode topics, we'd love to hear from you. If you want to join us and be interviewed and share some of your story, we'd absolutely love that as well. Please send me an email at kmilo@phys-empowerment.ca. Thank you again for listening. Bye.